Welcome, and I want to acknowledge you for taking the time to educate yourself on the two worlds of investing and taking the first step to understanding how to invest and potentially give you clarity and real freedom around your money. As you watch the videos, make note of any questions, yeah buts, how abouts, what if, so we can discuss and get you clarity. And today's conversation is really separating myths from truths, the story of investing. Now there's a couple assertions here. One, there are 4 destructive myths about investing. 2, there are 3 academic theories that dispel these myths. 3, there's academic applications to build a better portfolio. And 4, there's opportunity to achieve true investing peace of mind. So there are 4 myths about investing. What's a myth? A traditional story, especially one concerning the early history of a people or explaining a natural or social phenomenon, and typically involving supernatural beings or events. So some of the common myths are stock picking, track record investing, market timing, and the actual cost of investing. So myth 1, stock picking. That's actually choosing a stock based on the belief that it will do well in the future. And the myth here is investment advisors can consistently and predictably add value through individual stock selection. Now, stock selection comes in a lot of different phases and a lot of different forms. One is you go and pick a stock because you like that company or you buy that product. Or you pick a stock simply because you think it's going to go up, or maybe you think it's going to go down, so you sell that stock. What the professionals do is they pick stocks and they put it inside of mutual funds. And they actively manage all the different stocks and all the different bonds and think they should buy so that you can get potentially good returns. And actually what you're looking at on the screen here is the history of the mutual fund. This idea of mutual funds was started in the 1920s, and we've been creating more and more and more mutual funds every single year. But there's an interesting phenomenon that's happening, and it started in the late 60s. We actually started killing off these mutual funds. So if you look now at 2020, there's currently 32,095 mutual funds. But the total number born is actually 68,707. So we've killed off 37,589 mutual funds. And what happens when you kill that off is you don't have to disclose actually what the returns are. You take those dead mutual funds and you roll it into your current ones. But the reality is the worst 200 dead mutual funds have averaged a negative 86.13% cumulative total return. And that's not making the cover of Forbes or Fortune, but that's real. Now, this to me tells it all. If I actually take $100,000 from the 70s to now and I invested it in the average US mutual fund, I made money. My 100 grand grew to 4.9 million, which is great. But the reality is if I took that same $100,000 and just invested it in the S&P 500, so didn't stock pick, I'd grow it to over 10 million. And if I invested in the Makris market, which is really just every single stock on the stock exchange, so not even engineering the portfolio correctly, just buy everything, I'd have over 11 million. So there's a $6.1 million gap in the amount of wealth someone should be receiving versus what they actually are receiving. And as I mentioned, if you take it a step further and engineer a portfolio correctly, and I compare it to all mutual funds, that's international mutual funds, fixed income, 100 grand grew to 2.3. But again, if I engineer that portfolio correctly, which we're going to show you how you do that, in an aggressive portfolio, I could have grown that 100 to over 27 million. In that balanced portfolio where I have half the money exposed to fixed income, I could have grown that 100,000 to 9.3 million. So again, huge difference in what the stock pickers are doing versus what the market can actually do. Myth 2 is track record investing, the use of performance history to determine the best investment for the future. And the actual myth is finding a fund that did well in the past is a reliable method of indicating it will do well in the future. And so let's look at that. Let's see what the best money managers have been over the past periods of time. So let's look at 2001 to 2010. And the top 30 US equity fund managers average 15% a year. And they did far better than the S&P, which was averaging 1.4, and the Makris, which was averaging 2.5. So there you go, track record investing. Let me just go invest in these top 30 US equity fund managers, and I'm expected to get a far better return than the market moving forward. But that's not what happens. 2011 to 2020, they're up 6.3%, and the market's now up closer to 14. And it doesn't really matter what time frame you look at. You can take 2011 to 2015, the top 30 equity fund managers were up 31.49%, market was only up 12, and then the environment they invest in changes and they begin to underperform the market. And this is why you see the commercials that say past performance is not indicative of future results, because a manager's ability to pick stocks in the past has little to no correlation with his or her ability to do so consistently in the future. Myth number 3, market timing. Any attempt to alter or change the mix of assets based on a prediction or forecast about the future. And the myth is money managers are able to utilize market timing to effectively predict up and down markets. Now, there's a company out there called Dalbar, and Dalbar doesn't have a dog in the fight. They don't have funds they're trying to sell. They really just crunch data. And what they've actually shown is from 1991 to 2020, the S&P 500 was up 10.7%. And the average investor inside of an equity fund, one of those mutual funds or whatever fund, is up only 6.24%. 6.2. So there's over a 4% gap, again, in the amount of wealth that someone should be receiving versus what they actually are. And a big reason for that is market timing. And this slide has a lot going on here, but it's incredibly powerful, so I want to walk you through it. So from April 1st, 2001 to March 31st of 2021, there's been 5,000 trading days. What's a trading day? It's just a day when the market's open. So it's not a Saturday, it's not a Sunday, it's not a holiday. And if I had $10,000 and I just stayed invested in the S&P 500, I'd have over $50,000 of growth. Pretty good. But let's say I missed just 10 of the best trading days in a 5,000-day trading period. I just missed 10. I cut my return in half. I go from 50,000 to 23,000. And you follow that trend all the way. If I missed 30 of the best trading days, I actually lost money. Again, you have an opportunity here to get 5 times the return of your initial investment just by owning the market. But then you try to implement market timing and you erode away that wealth very quickly. And you've got to be careful because market timing actually comes in a lot of different forms. There's this term called tactical asset allocation, and all it is market timing in disguise. It's the idea that I'm going to know when to get you into a certain asset class, or when to get you into a certain segment, or when to get out, or when to get in. And the reality is nobody can predict the future, and that's why market timing doesn't work. And Dr. Ellis himself has a great quote on this. The evidence on investment manager success with market timing is impressive and overwhelmingly negative. So myth number 4, the cost of investing. Fees incurred by investors to buy, sell, and own stocks or mutual funds. The myth is what you don't see can't hurt you. So the cost of investing, and there's 2 costs associated with investing. There's the mutual fund expense and the bid-ask spread. Now the mutual fund expense is pretty clear. It's disclosed. Do you want to go buy a fund? It tells you how much that fund is. The bid-ask spread is not. If you've ever bought or sold a stock yourself, you've noticed that there's 2 numbers there. There's a sell price and there's a buy price. And the little difference actually is a cost that goes to the market maker. And that cost can actually be very expensive. Take micro for an example, which is an amazing asset class to own. You sell a micro stock and buy another micro stock, it can cost you 64 basis points, which is over 0.5%. That one transaction alone. So the cost you may not see is massive. The bid-ask spread as a percent of the price is an estimate of actual trading costs. This estimate is over 8 times as great for the smallest market segment as for the largest market segment. So the question to ask yourself is, how much better must the active manager be to at least recover the cost of active management? And as Dr. Ellis said, the answer is daunting. So far we've talked about the myths: stock selection, track record investing, market timing, and cost of investing. So now let's get into the truths. Now, there are 3 academic theories that dispel these myths. Before I get into them, let me explain the Mattson method. It is an investment approach based on 50 years of sound academic investing research and accepted financial theories I'm about to share with you. And it's a disciplined approach to seek to capture market returns while managing volatility. The language there is very important because the word discipline is really the key to the whole thing. I understand sometimes it's very, very hard to watch your hard-earned money drop 10, 20, 30% and think, I just got to stay calm, or maybe I need to buy more of this. Or you're watching your portfolio go up 5, 10, 20, 30% and think, man, maybe I should dump more money in. But if you can stay disciplined, then you can get those returns while managing risk. So let's talk about the components of the Mattson method. Component 1, efficient market hypothesis. Component 2, modern portfolio theory. And component 3, the 3-factor model. Who came up with these different components and concepts? Well, it's real smart people, real economists like Harry Markowitz and Merton Miller, both who won Nobel Prizes for their concepts in economics and their modern portfolio theory. Then you have Rex Singfield and Roger Ibbotson, who co-wrote the book Stocks, Bonds, Bills, and Inflations. And then, of course, Eugene Fama, who also won a Nobel Prize for his 3-factor model, and Kenneth French, who worked with him on that concept. So, component 1, efficient market hypothesis. In a free market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. What the heck does that mean? I'll use an example. Let's say you own a home, and let's say you decide you want to sell your home. Is your home actually worth what you think it's worth? Is your home worth what the real estate broker says it's worth? Is it worth what the tax company appraises it for? No, it's worth what people buy it for, right? And that's how all goods and services work. A bottle of water is worth what you want to pay for it. An iPhone is worth what you want to pay for it. And if you don't want to buy the product, you don't have to. So the reality is free markets work. But if you do believe free markets fail, well then you think markets fail to price goods and services efficiently. You think underpriced or overvalued markets can be forecasted and predicted. And people with this view use traditional investment approaches. But if you believe free markets work, free market is the best determinant of market prices based on supply and demand. All available information is factored into the current price. Only new and unknowable information changes events and changes pricing. The randomness of the market makes it impossible for any individual or entity to consistently predict market movement, and people with this view would utilize free market investment strategies. And in all things in life, belief should dictate action. If you believe free markets work, focus on capturing market returns. Eliminate traditional investment strategies. Utilize asset classes or structured funds. Diversify prudently based off the risk you're comfortable with. And work with a coach who shares in your belief and is there to support you. If you believe free markets fail, well, yeah, focus on active management. Pursue traditional investment strategies. Stay connected to multiple sources of information because you've got to be the first one to buy it or the first one to sell it. And work with someone who shares in your belief and they'll just do it for you. So that was component one. Component two is modern portfolio theory and the fact that diversification works. So 1990, Harry Markowitz, William Sharpe, and Merton Millier worked together to come up with these concepts. And just a little bit of information about Harry Markowitz. He actually graduated with an economics degree from the University of Chicago and won his Nobel Prize in 1990, of which that work started back in the 50s. And here's his baby right here, the Markowitz Efficient Frontier. Now, look, when you win a Nobel Prize, there's a lot of math and a lot of science that goes into it, but conceptually, this is pretty easy to understand. If you're willing to take risk, and standard deviation is how we measure risk, there's actually a return premium you should be receiving. So if you don't fall on this Markowitz Efficient Frontier, then there's inefficiency or improvements we can make to your portfolio. And this whole time I've been using the S&P 500 as a good example, and let me tell you, it is a good place to park your money. But it itself doesn't fall on the Markowitz Efficient Frontier because it's just one asset class. So let's talk about multiple asset classes. So what really determines a portfolio's performance? What did Harry Markowitz discover? Well, market timing is a factor, stock selection is a factor, but 91.5% is asset allocation. In other words, what assets do you own and how are they allocated? So what Harry Markowitz realized is it comes down to the asset classes and the correlation, technically lack thereof. And what you're seeing on the screen is the idea that you can invest in investment A or B, or you can invest in both of them because they're uncorrelated and you would get a return for less risk than investing in any just one of them. And let me give you a really clear example of how that works. So if I take the S&P 500 from the 1970s to now, you're going to make 10.74% and your standard deviation is 16.68. But as I begin to add uncorrelated assets like international small, I can actually get a higher return, 11.11, and lower my standard deviation, 16.32. So it seems very counterintuitive, but this is how you win a Nobel Prize. You play with things like correlation and you come up with that Markowitz Efficient Frontier. So the third component is the three-factor model, and it's a measure of the market factor, the size factor, and the value factor. So let's touch on each of those. So starting with the market factor, equities are riskier than fixed income. Stocks are riskier than bonds, but they have historically paid a higher rate of return. Therefore, it's an asset class you can own. If it pays premium relative to risk, you can own it. In fact, you should own it because look at how good the returns are in relation to fixed income. The second is small, which is really just a size factor. And just like stocks are riskier than bonds, small stocks are riskier than large stocks, but they pay a higher premium. So again, it's an asset class you should own. The third factor is the value factor, value versus growth. Now, value gets thrown around a lot, but there's really nothing wrong with value stocks. They're simply distressed companies or they've just taken on some debt. And as you can see, value companies have a higher standard deviation, but they've also paid a much higher premium. So again, it's an asset class you should own. So what is the academic approach? It's you take efficient market hypothesis, which is the concept of supply and demand, and we know that works. You add the three-factor model, which shows us what asset classes you should own, and then you diversify. You use modern portfolio theory to actually engineer a portfolio correctly, and that's the Mattson method. So let's apply academic research to build a better portfolio. So you remember that Dalbar study. Average investor from 1991 to 2020 is getting a 6% return, and they're taking 17.6 units of risk. They could just go buy the S&P 500 index and get a 10% return and actually take less risk. And this is what investors want. They want higher return for less risk, and they're actually doing the opposite. So why is that? Why are returns so low? Well, the average holding period is only 3.5 years. People just don't hold their funds long enough. Markets get crazy, or they're trying to chase returns, and they get poor performance. As I mentioned, they chase market returns, they stock pick, and they market time. All the things we've just discussed. So how do you create a diversified portfolio? Well, you start with the market. No more stock picking, no more market timing. You own the 500 index, then you add some fixed income, then you add some international, then you add some small and some value, and that's how you engineer a better portfolio, getting a 10.5% return and taking way less risk, only 11.5 units. Now, that's kind of a quick example. Let me show you how it's really done. We use three core funds. The first is our free market fixed income fund, which is only made up of asset classes that pay premium relative to risk. And then we have our free market U.S. equity fund, which again is only made up of asset classes that pay premium relative to risk. You'll notice here there's no penny stocks, there's no crypto, there's no mid cap. It's just asset classes that pay a premium relative to risk. And then we use a free market international fund, again, made up of asset classes that pay a premium relative to risk and combined based off your risk profile. And this is what a properly engineered portfolio looks like. Exposed to over 20 different asset classes in 40 plus countries, 20,000 individual positions. But the best part, no stock picking, no market timing, no track record investing. You're owning the market, engineered the right way to get you the highest return possible relative to risk. And that right there gives you opportunity to achieve true investing peace of mind. Again, I want to acknowledge you for taking the time to educate yourself on the two worlds of investing. I hope this is really informative and helps you to take a step closer to understanding how to invest and potentially give you clarity and real freedom around your money.